Question B. Refer to the information under the heading Stacy Trust. You are required to calculate the donations tax, if any, that may be payable by Alicia Moore during the 2025 year of assessment. Should there be no donations tax, you are required to provide further information to substantiate your answer. Alicia Moore has had no donations other than what is apparent from the information presented. Okay, so let's go see Stacy Trust. Right, so the Stacy Trust. So if we go and look at the Stacy Trust, they're asking about Alicia, and here's Alicia. Alicia disposed of the following assets of the trust. So she donated some shares. That was in the 2024 year of assessment. Then the boat was donated on the 1st of March 2024, which is this 2025 tax year. So that is the donation that we can see. Okay, so C. So the donations tax, so what we use is the donation of the boat. The market value was 410,000. This is on the very first day of the tax year, so she definitely at this point in time still has an annual exemption available. They don't tell us anything else that she's used it for. Any other donations considered to happen before this. So, sorry, this is question B. So that's 100,000 rands. So 310,000. That times 20% is 620,000. She made this on the 1st of, they're not asking us specifically for it here, but she did this on the 1st of March 2024. So remember, it is payable by the end of the next month, which is 30 April 2024. Okay, now remember, I'm just going to make this comment here. You will consider this for paragraph 22. So when you make a dispose of this asset, because she's liable to pay it, she should consider or calculate paragraph 22, which we'll look at in a bit. Right, so now C. Refer to the information on the Stacy Trust. You are required to calculate the taxable income of Alicia, Marcia, Garth, and the Stacy Trust. Provide clear explanations reference to the Act, and Alicia Moore has had an assessed capital loss of 50,000 rands at the end of the previous year of assessment. Okay, so a 30 mark, big one here. This question tests quite a bit of trusts. It also tests your knowledge of CGT and trust, as well as Section 7, as well as in general some income rules and things. So it's reasonably comprehensive. So we'll just have a heading for each of these. I recommend you do the same, just make it nice and clear for yourself. And for the examiner, who they're looking at, give yourself enough space, especially for these big questions. Marcia. Garth and the Stacy Trust. Okay, so for each of these, we're going to have you only have to put it on once, description, calculation, explanation, but these are the columns that we always have in our income tax calculations. Make it nice and clear, nice and neat. Okay, so guys, this is now a big question, and there's always the risk of feeling like you get a little bit overwhelmed. The best thing is to just start at the top, work your way down, address it as it comes. So, quick recap. This trust was formed by Gwen Stacy 2 years ago. These are the beneficiaries of the trust. Alicia, which is one of the person we're looking at, is the daughter of Gwen Stacy. Gwen Stacy has passed away. So what I want you to understand about Gwen Stacy, unless they specifically ask us something about Gwen Stacy, maybe do a calculation, what would she have paid in the past, something weird like that, unless they ask something like that, which is unlikely because this happened 2 years ago. Unless they ask it like that, you treat her just as to understand that this is a source of, she passed away, and some of the income or some of the assets like the cash in the holiday house come from her. But there was no living donor, so none of the income or capital that arises from these assets can be subject to Section 7 or what's that, paragraph 68 to 72 basically, which are the sections which tells you that even though the beneficiary might receive it, the donor gets taxed. So for example, if it goes to a minor child from a parent, Section 73 says the parent must be taxed. Now, that only happens if the donor is still alive, and you can tax the donor. The fact that she passed away 2 years ago, which means these amounts cannot be subject to Section 7. So that's the most important thing that you have to understand about Gwen. Okay, then we're done. These are the beneficiaries. Alicia, which is the daughter of Gwen, and Marsha and Garth, which are the children of Alicia. So so let's say it like this, just maybe to help us like this. Grandmother, mother, and children. So just even recommend for yourself, if you struggle with these type of things, take your time, draw out a family tree. Basically, I honestly would recommend that you do something like this if this is something that you struggle with. Okay, but guys, so Alicia married out of community of property to Peter. So those are all important things. And another important thing to remember here is that Garth Moore, her one child, is 16 years old, which is a minor. So that's a Section 7(3) risk. Okay, let's go down. Then they tell you what Gwen bequeathed. Remember, Gwen passed away. Then they tell you what Alicia bequeathed. Now, Alicia is one of our taxpayers we have to deal with, so this is important. So the shares in Alchemax, what we see over here, this is talking about the disposal to the trust. So there's nothing to do here because this happened in the past. It's important for us to just note here that she disposed of it at the to the trust at a time when the market value was 150. So that's the base cost for the trust. Okay, but for now, nothing here. So what do we see here then? Then we have this situation here where Alicia donated the boat. So this is a disposal of an asset. It's not a personal use asset. We don't know how long the boat is, but it's not that rule about the 10-meter long boat that we're looking at here. It's not a personal use asset because it's used to generate income. It's not used for personal purposes. They're renting it out to an independent third party. So this is a business asset, and it was written off over 12 years at the time when Peter Moore acquired it, okay, when it was new. And that's what we'll look at now. So let's actually just start just with that. So we go to Alicia. The boat was donated when the market value was 410. Okay. So let's start. Disposal of the boat. Okay, so I would recommend that we start with the recoupment because there would be, remember we always start with the recoupment because we're going to use it for our capital gain calculation. So the cost of this asset. Now this is the first trick what this question is trying to test you on. Peter Moore purchased for 500,000 including VAT. So the first, I suppose, trick is that you see that they're not VAT vendors. So we can't claim input VAT, so we'll use whatever the amount, including VAT, is as our cost. All right, so this is what they're trying to test you with here. Do you think that the cost is 500,000, or do you think that the cost is 480,000, which is the market value when Peter donated it? Now remember, usually, if this wasn't spouses, this would be the cost to Alicia. Consider the cost to Alicia, even if it was a donation, if they weren't spouses. Because they're spouses, though, this is the cost. She's treated as if she bought it on the 1st of March for 500,000 including VAT and then leased it to Charles. That's what this rollover of spouses does, is you replace the names almost. It's literally almost like you went and say, instead of saying Peter there, it says Alicia. So that's the idea. Okay, so 500,000 on the 1st of March, beginning of the tax year. So for the year 2023 and 2024, 2 years they used it, and it was disposed on the first day of this tax year. So cost 500,000. Less section 11E. The first year it was bought was 2023. It was bought on the 1st of March 2022. 2024. And then 2025, which is this year, I'm just going to make the comment here. It was not used by Alicia. Okay, so can't claim it. So 2023, 500,000 divided by 12 times 12 over 12, and 2024 is exactly the same. 41667, 41667 gives us a tax value of 416667. Okay, so just make sure you see here, usually if there was an amount here, we're just going to remember to deduct it there, but there's nothing to deduct in this case. Okay, how much was it disposed of to the trust? They tell you it was donated when the market value was 410,000. Okay, when the market value was 410, that's when it's donated for. So you sell it to the trust, you donate it for free. But remember, this is the, I'm going to just call it here, deemed selling price. The deemed selling price, limited to original cost. That's the same as what we always write, except it's not usually just deemed. But paragraph 38, the H schedule tells you if you make a donation, you must use the market value as if that was the selling price. Now the market value is 410,000. Okay, so 410 minus 416667 gives us a loss amount of 6667. Now, if the taxpayer chooses to apply section 11.0, important, the taxpayer must choose it. You can usually go and claim that 6667 like that, but careful now. In this case, section 11.0 is not applicable because, and there's actually two reasons. The first one is it was written off over more than 10 years. If you go and see, it must be limited to, it can't be more than 10 years. That's a useful life. But that's one requirement. But in this case, there's another one also, and the disposal is to a connected person. So you can't claim it there. Okay. Now usually that then means if the taxpayer doesn't claim it here, or they can't, then you should consider it when doing this capital gain. Okay, now let's look at the capital gain. Capital gain starts off with the proceeds, and this is again paragraph 38 that tells you it must be the market value less the recoupment, but that's not a recoupment, that's a loss, so there's no recoupment. Right, so that gives us 410,000. Then we have the base cost. Now, very important here, let's start like this. The base cost is calculated as cost less allowances. And when I'm talking about allowances here, for the purposes of this example, I'm talking about these 416,667 amounts there. So the total is 83333, like that. Okay? And then any other allowance, paragraph 22 must be applied. Now, if just reminding you, let's say you did claim 100 rands a year for section 11.0, you would then say section 11.0 100 rands. Okay, that's just a bit of a quick revision. Paragraph 22. See the calc. Okay, so let's quickly just fill in the rest. So the cost of this asset was 500,000. Okay, and let me actually just make this cost here for you the reference. Section 9HB, remember that's the rollover from spouses. So cost is 500. The allowances is that amount we calculated there, that 83333. Paragraph 22, let's do our calculation. Okay, so paragraph 22 calc. So if you go and look at paragraph 22, it tells you it is M minus A over M times D. M is the market value, 410. A is everything else is in base cost, so it's those two amounts. 500,000 minus 83,333, sorry. So basically what they're trying to tell you is the base cost. And then D, C, part B of the question, it was the previous question. We calculated the nation's tax of 620,000. Now, so usually you fill these numbers in, but now we have a problem. Because M minus A, okay, M is 410 and A is 416,667. Can you see you would make a loss? This is like proceeds minus base cost basically. If you make a loss, because M minus A is negative, paragraph 22 is considered to be null. So basically it just means you must use null there. You can't use a negative amount or a negative, so a positive amount. You can't do that. Okay, so just as a reminder guys, paragraph 22 always applies if there's a disposal of an asset and there was the nation's tax. So this gives us 416,667 and this gives us a capital loss of 6,667. Right, so you can see it's still that same amount we're chasing around. Now, can you claim this? So usually that's now going to your CT column. Right, so sorry guys, my spacing is a little bit out here, but here we go. Cannot claim capital loss as it is to a connected person. Paragraph 39 tells us that. It tells you also you can just knock this 6,667 off against a future capital gain to the same person. Okay, so that's it from there. Let's quickly go back. So that's not this disposal. Then they tell you, remember now, this boat now has a useful life of 10 years that we have to claim from there. So we're going to bring that into account. I'm just going to make a comment here. Remember section 11E. Okay. So, but for now, let's move on from there. We'll handle the rest of that boat for the rest of the year. We then have the shares in Alcumax. Says these are the shares that were donated by Alicia. So this is the ones in the previous year. The trust received 40,000 rands a net amount, so that's after dividends tax of 20% in its bank account on the 15th of April from Alcumax. So we have to gross it up, times 100 over 80 gives us 50,000. You have to show this calculation also in your script, obviously. And then they tell you 50% of that went to Marcia and 50% went to Garth. Right. And then they sold it on the 10th of August. So let's just hold on for the sale. Let's do the dividends first, and let's start. It goes to Garth and it goes to Marcia. So let's go to Marcia here and we say Alcumax. These are the dividends. So it is, I'm just going to write once here. You only have to show the ones. Gross dividend. Okay, so 50,000 times 50%, which gets half of it, goes to Marcia. Okay, so let me just, before I continue here, just remind you of our thought process when we're looking at trusts. let me do it on a new page. You start off here and you say, was there a donation and is the donor alive? If you say yes, consider section 7. Does it apply? Yes. Tax donor. Was there a donation? Is the donor alive? Yes. Consider section 7. Does it apply? Yes. Tax the donor. Okay. Was there a donation? Is the donor alive? Yes. Consider section 7. Does it apply? No. Okay. Was there a donation and is the donor alive? No. So those two are the same. Then the question is, okay, so I'm going to build it from the start. Was there a donation and is the donor alive? If you say yes, you should consider section 7. Does it apply? If you say yes, the donor is taxed. Go back up. Was there a donation and is the donor alive? Yes. Consider section 7. Does it apply? No. Okay, that or was there a donation and is the donor alive? No. Both of those lead to the same question. Does the beneficiary have a vested right? Or, those can be used either one. Did the trustees distribute something to the beneficiary? If yes, then the beneficiary is taxed. This is section 25B and also section 25B, the trust, if no one else is. So this is the constant question that we ask ourselves. Well, this question we've looked at now of Marsha, this 50% distributed to Marsha, we ask ourselves, was there a donation and is the donor still alive? Yes. These were donated by Alicia and she's still alive. Does any of the section 7s apply? So the ones you should consider, section 7.3, minor child. Marsha is not a minor child. She is 25 years old. Section 7.5 applies to the amounts retained in the trust. Section 7.8, non-resident. None of the other section 7s are applicable in this case. So she gets taxed on it per section 25B1 basically. That full amount is then exempt for her in terms of section 21 or section 10(1)(k). Remember, you get all of the allowances and all of the exemptions and deductions that goes with the amount that gets included. The other 50% goes to Garth Moore. So here's Garth. Now who is Garth? Garth is also a son of Alicia, or a child of Alicia, but Garth is 16 years old and a minor child. So there's a section 7.3 risk. We made a note to ourselves there. Okay, so was there a donation? Is the donor alive? Yes, Alicia is the donor and she's alive. Does section 7 apply? Yes, she's a parent and this is a minor child, so who should be taxed? Alicia should be taxed. And you can test yourself against that the whole time. So I recommend you just go to Garth here, and I'll just include it here, Alkimax dividend, section 7.3, Alicia taxed. It's much better if you can reference a section like that, guys. It's quicker than writing out parent to minor. So Alicia is taxed. We go to Alicia. Okay, so this is Alicia, guys. After everything we've done, I'm just going to make another rands column and CGT column there just to make it a bit clear for us. And this will be Alkimax dividend to Garth, section 7.3. It's 50,000. That's the gross amount, remember, times 50%. 25,000, she can get section 10 1K. To save time also, you can add up all of the different dividends that she receives and just do one big calculation, although you have to show it. But as long as you don't forget an amount, so be careful of that. I prefer to actually just quickly write it out like this for each one I get. Alright, so this is this first part done. Now they sell the shares in Alchemax, and they give the proceeds equally, they split it equally between Marcia and Garth. Alright, so what I'm going to recommend we do, and you could do this calculation basically in any of the taxpayers' calculations here. You could do it in Marcia or Garth's or the trusts or even Alicia's calculation. I'm going to just do it in the trust, because the trust is like the central point. So let's do the CGT calculation there. It was sold for 280,000 rands. And I'm just reminding you, when she donated it, it was 150,000 rands. So again, I recommend we just do it in the trust. If you're unsure where to do a big calculation like this, do it in the trust. Or do a big calculation that says calculation of the capital gain on the disposal of shares. So Alchemax disposal. There's no capital gains to be claimed on this, so it's the proceeds, and the proceeds was 280,000 rands less the base cost. So the trick here is that you know the base cost is the market value on the date that Alicia donated it. That gives us a capital gain of 130,000 distributed as follows. Garth, 130,000 times 50%, 65,000, and Marcia also 65,000. So these are now capital gains that wants to go into our CGT column. So now important, paragraph 80 will apply, and paragraphs, let me just give you exactly, just sure again guys. Yep. Trust my gut, 68 to 72. Okay, now basically what these ones do, paragraph 80 is equal, this is roughly speaking, to section 25B, and paragraph 68 to 72 is equal to section 7's requirements. So here when we do this question, we say, was there a donation and is the donor alive? Yes. Consider section 7. You can also say consider paragraphs 68 to 72. Does it apply? Yes, tax the donor. Same story here. And here where you say section 25B, you could also say paragraph 80 / paragraph 80 like that. There's a small difference between some of the sections, but overall this is the best way of looking at them. Okay, so we do the same thing. We ask, for this CGT, this disposal, was there a donation? Is the donor alive? Yes. Consider section 7. Does it apply? Yes. For Garth is a minor. Marcia will be taxed in terms of paragraph 68. So let's just go to Garth here, and I'm going to say Alchemax dividends and Alchemax capital gain. Now it's paragraph 68. Not 68, sorry, 69. Paragraph 69. And that says Alicia is taxed. It's again parent to a minor. So let's go to Alicia. So this is the Alchemax dividend to Garth. This is the capital gain to Garth. Paragraph 69. And this goes into our CGT calc, as you can see. The other 50% went to Marcia. So this is the Alchemax dividends. Here's the Alchemax capital gain, 65,000. And her reason is because of paragraph 80. It says the trust shouldn't be taxed on it. The beneficiary should be taxed on it. So let's make sure. So we've done that. We've done the disposal. Now we've got the boat. The boat, remember they received the boat on the 1st of March of this tax year. They got 5,000 rands a month from Charles. That's the income. And then they distributed 30% to Garth, 40% to Marcia, and the remaining 30% remains in the trust. There was remember, Alicia donated us. Now, here's also a comment. Remember section 11E. I feel like this is a reasonably simple one to forget, potentially. Now, first of all, let's go to the trust again, and let's do the calculation here. So far on the trust, I just want you to see all that we have in the trust here, calculation. There's nothing in these columns yet, CDT and rands. So here we have the boat. And I'm going to say this, calculation of taxable income. Because we only look at the tax effect of this. So the income was received was, this is the gross income, so let's call it gross income. 5,000 times 12 is 60,000. And then there's section 11E. She donated the boat to the trust. 410,000, and there were 10 years left. This is on the first day of the tax year. So 410,000 divided by 10 gives us 41,000. Okay. So that's 19,000. This is distributed as follows. You just have to somewhere show your calculation. I feel this makes sense to just show it nice and cleanly in one place. Garth gets 30%, Marcia gets 40%. So 19 times 30% gives us 5,700. $7,600. And that obviously leaves us with how much? The same 30%. So let's go through each of them from the top. So we're now looking at the boat, the taxable income. Remember, guys, section 25B says, if you go and read through the whole section, so subparagraph 1, 2, well, whichever the last ones are. But if you're going to look at subparagraph, let me just give you exactly right, 3. Yes. If you go and look at subparagraph 3, guys, of section 25B, they tell you you can claim all the deductions and allowances against it. So that's what we're doing. Okay, so Garth's 30%, let's start with Garth. So this is the boat income. Section 7.3 will apply again, and Alicia will be taxed. Is the donor alive? Yes. Does section 7 apply? Yes. Section 7.3. So Alicia will be taxed on the income from the boat. We go to Alicia. This is Alicia again, guys. Let's do the boat income. To Garth, section 7.3 applies. And what was the amount? 5,700. So 5,700 goes into her income. So you've done that first one. Then Marcia, 7,600. Was there a donation as the donor alive? Yes. Does section 7 apply? No. Marcia was received the amount, so Marcia should be taxed on it. Boat income, section 25B. And what was that amount again? 7,600. And then the last bit, the amount retained in the trust. Was their donation, is the donor still alive? When an amount is retained in the trust, the only person that can be taxed on it is either the trust or the donor. The donor is taxed if no one else can be taxed on it. So let me actually rephrase it. When an amount is left in the trust, that amount either belongs to someone and they just haven't received the money yet. So for example, if I say my child must receive it, but only when they're 21. If they die before and pay into the estate, but otherwise wait until you actually transfer the money. The child will still be taxed on it if they have a vested right. Unless, again, Section 7 overrides it. So if this 5,700 rands belong to Garth, even though it hasn't been paid out, then Alicia will still be taxed under Section 7.3, the parent. But now, that doesn't belong to anybody. It's retained in the trust, it doesn't belong to anybody. Section 7.5 is the section that will then apply. Sorry, and I actually wrote that earlier instead of writing 30%. But that's Section 7.5. So usually we'd include it here for the trust now, but Section 7.5 will apply, and I'm just going to make a comment here. Alicia is taxed. So we go to Alicia, and this boat income, the amount retained in the trust is taxed in her hands under Section 7.5. Okay, so we've done all of those. The boat income. We've done, well, that's the donation. We've done all of that. Then we have the cash. The trust had a cash balance of 200,000 rands at the beginning of the year of assessment. The cash balance generated interest of 21,000 and the amount was retained in the bank account. Who does that money belong to? No beneficiary. So this is money that the trust received, 21,000, but it didn't pay it out to someone and it doesn't belong to someone. Was there a donation? Is the donor alive? No, because it's Stacy who passed away. So does the beneficiary have a vested right? Does it distribute it to the beneficiary? No. So who should be taxed? The trust. Right, Section 25B, there's no donor because Gwen passed away. It doesn't belong to anybody, so the trust must be taxed. $21,000. Then I would always just recommend, so always marks for it, but Section 10.1I just talk about it. That's the interest exemption, and this is not available as it's not a natural person. The trust received it, not a natural person. Then the holiday house generated rental income of 33,000 and it went to all the beneficiaries. Remember, the beneficiaries are 3 people, Alicia, Garth, and Marsha. The holiday house was donated by Gwen. Was their donation as the donor alive? No. So who should be taxed on it? These 3 people. So let's start with Alicia. This is the holiday home rental income. Section 25B is why she's getting taxed. 33,000 divided by 3, so she gets her share of that, which is 11,000. Then we go to Marsha. Holiday home rental, Section 25B, 33,000 divided by 3, 11. We go to Garth, who has not been taxed on anything so far. Can you see? Holiday home rentals, Section 25B, 33 divided by 3. I suppose you only have to show it once. That. Then what happens on the 1st of April 2024, so it's in this tax year, the trustees dispose of the holiday home to Happy Holidays in return for 500 shares. Happy Holidays provides a holiday accommodation to international travelers, and the house in Bantry Bay would be used. The market value of the holiday home was 5 million, and the market value of the shares were 4.9 million. Right, so that's what we basically sold it for 4.9 million. The trustees were willing to accept the lower value as they believe the value of the shares will increase significantly over time. During December 2024, the Stacey Trust became unconditionally entitled to a gross dividend of 40,000, and this was retained in the trust. Okay, so let's just take it one step at a time. Disposal of the holiday home. Now, Section 24BA will apply to this, but important, there's a capital gain that's calculated in Section 24BA 3A, but that's taxed in Happy Holidays' hand. Remember, if it was the other way around, if the asset was 4.9 million and the shares were 5 million, that 100,000 rands would be treated as if it was a dividend in specie paid by the company, Happy Holidays. So this trust would be treated as if they received 100,000 rands as a dividend in specie, which would be exempt. Just that's again just a quick little revision for you guys. So we go to the trust. No one has a vested right to this. Disposal of holiday home. Proceeds 4.9 million. Base cost. What was the base cost? It was donated or bequeathed by Gwen. The market value on the date of her death, 4 million. And that goes into our CDT column. Doesn't belong to anybody. Then there was a dividend received. From Happy Holidays. Doesn't belong, there's no one with a vested right, and it wasn't paid out, so it gets taxed in the hands of the trust. Was that the gross amount or net amount? Gross amount. Alright, so that looks to me like we've come to the end of our question. So we just need to finish and clean everything up. So this is now again Alicia. So what we do is we add up everything in the CGT column, and I'm just using an amount, the amount from your solution. Let's just make sure there was the 65. Yeah, that's right. 65,000. From that, you get to deduct your annual exclusion of 40,000. And I'm reminding you, this just again, guys, that subtotal there is now called the aggregate capital gain. Be careful if in the question they tell you they've given you the aggregate capital gain. You need to know that's after the annual exclusion has been calculated. Then we need to take into account any capital losses brought forward. And you'll recall that the required tells us that she had 50,000 rands at the end of the previous tax year, Alicia. So we deduct that 50,000. This gives us a 25,000 loss now, which is a net capital loss, and this will be carried forward. So we add up everything else, and that is our taxable income for Alicia. For Marsha, there was the 65,000 capital gain, so we add it all up. That then gives us, then we have our annual exclusion. This is again our aggregate capital gain. We then take into account as a capital loss, none. This gives us our net capital gain of 25,000. We then have our inclusion rate, 40%. Which gives us a taxable capital gain, 10,000. That gets added, and that's our taxable income. Remember, guys, my recommendation to you is if there was a CGT or disposal in the question, but instead of 65,000 you thought it was null, I would recommend that you would still write this out at the end of your question. So you would just use null, you would deduct 40 from that. It doesn't become negative, remember, it's just an exclusion, so it stays null, null, you'd show null, and then you write 40%. Because if you missed the CGT, then the solution is still going to contain marks for these annual exclusions and the 40%. But if you just leave this whole calculation out, you throw it away. So rather just put down the structure. Put down the marks that you know you can get. Then we've got Garth. Garth, we just add up these 11,000 as taxable income. Then we've got the trust. Okay, so we add up the trust. The trust does not get an annual exclusion. The trusts in this is then the aggregate capital gain. Then you'll look if there's a capital loss, calculate net capital gain, all those same things. But you can take this shortcut if you know for a fact there's nothing else. And the inclusion rate for trust, 80%. So 720,000, and that 720,000 goes into my rands column, and this is my taxable income. Alright guys, so before I move on, I just want you to see a couple of things here. These questions are challenging and you might have struggled with some of it, but I want you to understand throughout this question, and if you go and look in your solution, you'll see you get marks for all of the basic things that you also already do know. How to calculate allowances, how to calculate CGT, that a dividend is section 10(1)(k) is exempt, even if you calculate the dividend wrong. So you can still get a ton of marks, even without getting tricked by some of the tricky things. So just remember that. So don't get too panicked always. There's lots of marks to score. Don't let the tricky things throw you out. It's the big areas where you score a lot of marks. Question D then says, refer to the information on the Stacy Trust. What are the tax implications for happy holidays for the asset to share transaction? So this is this happy holidays area which we spoke of. So I'm going to remind you. Per section 24BA 3A, because the market value of the asset, 5 million, exceeds the market value of the shares, that 100,000 rands is treated as if it's a capital gain that was made by Happy Holidays. And so that would just include that into the CGT calculation. CGT. And then this is the cost of the asset. So if they could claim allowances, for example, they would use 5 million. It's calculated as the cost of the asset is in terms of section 40 CA, calculated as the market value of the shares, which is 4.9 million. It's the market value of the shares immediately after this transaction, plus any capital gain that was made in terms of section 24BA 3A. So 100,000. And then E, refer to the information on the Legion. They say SARS informed Legion that it will raise an underestimation penalty in terms of paragraph 20 of the 4th schedule. Discuss why SARS has raised it. Calculate the amount of the underestimation penalty, and you can ignore interest because it's mostly not in your service. Okay, so let's quickly go and see again. So I'm going to remind you what happened here. This company, and we'll talk about it quite quickly. This company made a first and second provisional tax payment before the due date. So that's good. It means there's no late payment penalties calculated in terms of paragraph 27 of the 4th schedule. They submitted for the first one, they thought the taxable income would be 4.5 million, or that's what they submitted. The second one, they submitted that it's 5 million. But their actual taxable income was 8 million. Because their actual taxable income exceeds 1 million, paragraph 20 says that the minimum amount that they can submit is 80% of the actual taxable income, so 6.4 million. So this is what their second provisional tax payment should have been based on, 6.4 million. They based it on 5 million. So the paragraph 20 underestimation penalty says, what is the tax that you should have calculated on the minimum amount, which is the 8 million actual taxable income times 80%. So 8 million times 80 times 28% is 1792. Less the actual taxes that were paid, 630 and 770. 630, 770. And there's no employees tax because we are a company and not a service provider. personal service provider company. Gives us 392. And that times 20% gives us 78,400. So that is the penalty that they will have to pay. So guys, that's the end of this question. And it's a reasonably tough question, I think you guys can see. Like I said again, throughout you see there's marks everywhere that you score for the basic things. So don't get panicked. Make sure that you go back to the work where you can, where you've identified big areas and with big gaps in your knowledge. When you work through this, if there are things that you really don't understand, go and fix it before it's too late. But if there's little tricky things that caught you, learn from it, obviously, but don't. If it's a section that's a small section that only pops up every now and then, which you haven't really seen before, you'll see most of the time they don't count a lot of marks. It's not enough to fail you ever. So focus on what you can, on what you do know, get the basics right, keep your head in the exam, get the easy marks. It's possible. You guys can do it. I know you can. Best of luck, push hard, good luck.